Hi everybody, welcome back to the Dividend Stockpile channel. For the first time on YouTube, I'm going to do a complete portfolio review. I'm going to be discussing all of my dividend investments throughout all of my accounts. So if that's interesting to you, please stay tuned. All right, so before we do that, I wanted to talk through the agenda of what we're going to cover today. So I'm going to start with my background and how I became a dividend investor, why dividend investing, going to compare growth investing versus dividend investing, going to review my portfolios, and also the details of my holdings in each, including the percentage allocation. And then I'm going to briefly discuss the recent buys and recent sells that I've made in these accounts over the last 3 months. So let's go. Okay, so a little bit about my background. I've been investing since 1999. Started off in my first job. I was able to sign up for my 401k. It was also the time of the tech boom, and so I was reading things like Yahoo magazine and things like that to identify single stocks to purchase. I really didn't know what I was doing at the time, but I bought a little bit here, a little bit there. If anyone remembers, back in the day, you could use CompuShare, which would allow you to do fractional shares way back before Robinhood and all the other brokerages. So that's kind of how I got myself started, right during the peak of the dot-com expansion and subsequent bubble, but we'll talk about that in a little bit. In the past, I was focused on growth stocks, index funds, the fear of missing out trades, again, things that I found in magazines or heard friends talking about, things like that. For a very long time, I was a value investor, so I focused on low PEs and low book value and things like that when it came to my investments. And I've also done some swing trading in the past where I bought something that I thought might go up for a few weeks or a few months and then sell it off. So in general, those all did not fit my style and my comfort level. Growth stocks obviously did well over time, and index funds served me well and allowed me to increase my portfolio. But as I've gotten older and my goals have been a little bit more clear, I've started moving past those types of investing, and now I'm focused on dividend growth. Dividend growth provides me the stability that I'm looking for, as well as the passive income that I desire to meet my needs. Over the last 4 or so years, I've also started being an option seller, selling options on my existing holdings, as well as using new cash to do cash secure puts and other things like that. If you want to get some more information about option selling, I'm including a video link at the top. You can take a look at one of my recent videos on how I produced a 58% return on my options only account. So as I've mentioned in previous videos, I am striving to be financially independent and retire early, and my ultimate goal is to be fully retired in about 8 years' time. So that would put me at about 15 years before the traditional retirement. So I feel like that's a good balance between using the time the way I want it, helping with my children, doing my casual things that I want to do without having the requirement of working a 9 to 5. I might still be recreationally employed, picking things I want to do as opposed to having a requirement. My wife likes to call it work optional. So that's our goal for about 8 years. So as I talk through my investments, that timeline should stay in your mind as why I picked certain ones that I've picked. Okay, so why ultimately did I decide on dividend growth investing after trying all those other types of investing? Well, the main thing is the comfort that it provides you, receiving a quarterly dividend payment from your investments without you having to do anything. So, as you know, dividends are cash payments from company profits to you as the owner of the company. Instead of relying on the market to go up over time and then selling off your shares later on, dividend companies will pay you cash as an owner every 3 months usually, and you can use that money for whatever you want. You can pay your bills with it, or you can reinvest it for more dividend stocks later on. As I mentioned, you don't have to sell your shares for income. With traditional growth investing, in order to realize the gains you've made, you have to sell your shares. With dividend growth investing, you still get capital appreciation, but you also get the dividends paid to you that you can use for real income to pay real bills. And after all, cash flow pays the bills, not capital appreciation. And another thing I love about dividend growth investing is dividends paid out compound over time. If you don't need the funds right now and you receive a dividend, you can reinvest it to buy more shares, which then pays you more dividends, and those dividends pay you more dividends, and so on and so on. They compound over time. Additionally, all the good dividend growth companies raise their dividend payments over time. So it's not uncommon to see companies raising their dividends 5, 6, 10, 20% in some cases every single year, year after year. So without you doing anything, the amount of income you receive grows. And if you reinvest those dividends, it's going to grow and compound even more. And what I'll show you in a little bit, and one of the main reasons why I turned into a dividend growth investor is the dividends provide stability in turbulent times. So let's look at some historical facts. So as I mentioned, I have been investing since 1999. So I wanted to show you what the quote unquote growth investing has done over that time. So I did a sample of QQQ and SPY, investing $10,000 back in January of 2000, and up until today, January 2024. So overall, you see mixed results. The compound annual growth rate, meaning the amount on average, if you divide it by those 20-something years, the QQQs has returned about 7.15%, and the SPY, or the S&P 500, has delivered almost 7%. Generally speaking, that's a good return, but it's not knock your socks off. The biggest concern that I have are the two boxes in red, and this is what I'm trying to avoid by switching over to dividend growth investing. The worst year over those last 24 years for the QQQ saw a portfolio invested in that particular ETF down 41.73%. That is a huge loss to stomach and hold on to over time. The S&P 500 has also seen as low as 36.81% in a single year of a loss. You're basically looking at your portfolio getting cut in a third or more, and there's nothing you can do about it. You're not gaining any additional income. You're just holding your shares and hoping that it recovers. If you were to retire during those worst years, you would automatically be cutting a third of your potential income or your potential balance if you had to use the money that year. Another really interesting figure is the max drawdown. So from peak to trough of these funds, the max drawdown for the QQQ was negative 81%, whereas the S&P 500 was down almost 51% from peak to trough. That is a huge drawdown in your investments. Imagine if you had $100,000 invested in the QQQ. Over the max drawdown, your balance is now about 19,000. That would be almost impossible to stomach and maintain your investments. And so that's one reason why I don't want to rely on share appreciation, is because you have no control over it. You're at the whims of the market. If you need the money and the market is down 40% or over a few year period is down 81%, and you try and sell your shares at that time, you're going to deplete your investments. A very important thing to consider is sequence of returns risk. So if the market tanks right as you need the money, it's going to be very hard to maintain enough in your balances to sustain you over your lifetime if you have really bad sequence of return risks and you lose a lot of share price over the first few years of your retirement. Looking down at the bottom, it shows the annualized returns of the QQQ and SPY. So as you see, most years are positive, as shown in the blue bars, but there have been plenty of times that the market has been down. And since 2000, 2001, you saw a drop down on both indices. 2008, you saw another drop. And then, of course, in 2020, when we had the COVID outbreak, we also saw the market go down. So if you were starting to retire or you needed your funds during those times, it would be very hard to do. In comparison, I wanted to also show what some dividend growth investing ETFs have done over a similar time frame. And because the ETFs, in this particular example, the newest one started in January of 2015, I went ahead and redid the calculations for all four as of this date. So during this time, the QQQs had a worse year of 32.5%, and the max drawdown at 32.5% as well. SPY for the S&P 500, the worst year was negative 18, and the max drawdown was 23.93. But then adding the Schwab US Dividend Equity ETF, SCHD, the worst year since 2015 was negative 5.56%, and the max drawdown was only 21.5%. Similarly, the iShares Core Dividend Growth ETF, DGRO, had a worse year of negative 7.90%, and a max drawdown of 21.92%. So in addition to receiving the income every month, I'm also heartened by the stability of the dividend payments over time and the dividend balance. And so it's a lot easier to reconcile with a 7 or 5% loss as opposed to 32 and 18%. It's a much more stable ride through your investment career. So in addition to providing a more stable ride in your investment, they also provide consistent growing income. Here are three examples of DGRO, SCHD, and SPY for the S&P 500 of the dividends growing over time. So instead of worrying about the market going up and down, if you invest in quality ETFs or quality individual stocks, you are likely to see your dividends, which means your income, growing over time, as represented here in these charts. Okay, in addition to providing steady, reliable income, historically, dividends and dividend growers have provided better returns than non-dividend payers. I showed this particular chart in a recent video, but dividend growers and initiators from 1973 to 2022, the growth of $100 would equal about 13,000, and the S&P 500 would be about 4,000. And for those non-dividend payers, you're looking at $694, which all of them provided a good return. You made money on your investments, but dividend growers have increased total return over this time period much more favorably than non-dividend payers. And one of the main reasons for that is reinvesting your dividends allows your balances and your share count to grow over time, which then compounds again and again and again, and makes huge differences over long periods of time. Okay, so now I wanted to switch over to the different investing portfolios that I maintain. For my dividend accounts, I have them in 4 different focused accounts. The first one and my main one is my brokerage account. This is a taxable account that I have that I'm going to be using for my FIRE journey. These are funds that I'll be able to use before retirement to fund our lifestyle. I also have an individual retirement account, IRA, which is focused on dividends. I have a self-directed 401k. Luckily, my employer allows me to pick the investments that I want in my 401k, so I can purchase dividend stocks, dividend ETFs, or anything else that I'd want with my 401k money. So I've chosen to focus on dividends there as well. And then my spouse has an IRA rolled over from previous employers, so I'm able to use that for dividend growth investing as well. As we're about to see in the different portfolios and the holdings that I have in each of those, you really should determine your yield and growth choices based on your timeline. And up on the top of your screen, you see a link for a video I did recently with that same title, meaning depending on your timeline, your yield might need to be higher and your dividend growth could be lower because you need the funds more soon. As opposed to people who have a long time frame, your yield might need to be low right now and have high dividend growth so it can grow over time. All right, so now we're here inside of the individual portfolio holdings. I'm going to start off with my brokerage account. So before I do that, please know that you need to do your own research for any holdings. These are just my holdings at this point in time. They fit my needs and my comfort level, but it may not fit your needs. So please take that in consideration before doing any investing. And remember, I'm not a financial advisor. This is just for fun and entertainment. And hopefully it gives you some ideas of how to build your portfolios over time. So this is my brokerage account. The current yield is 6.28%. And so as you see in the first column is all the different individual stock tickers. The second column is my current allocation in my account, how much the portfolio, how much of each holding is in the portfolio, and then the changes from the last quarter. So on 9/1, it was that percentage, and then how much has changed over time. So as you see in my brokerage account, I hold a little bit of Apple, some AbbVie, ADC, ADM, which is Archer Daniels Midland, APLE, which is Apple Hospitality REIT, ARE, Alexandria Real Estate Properties, BAM, which is Brookfield Asset Management, BCE, which is Bell Canada, BDJ, which is a closed-end fund through BlackRock. It invests in dividend companies. BEP and BEPC, have a little bit of each of those. BIPC, which is Brookfield Infrastructure Partners Corporation, BLK, BlackRock, BST, which is a science and technology closed-end fund, CAH, which is Cardinal Health, CLX for Clorox, Cube, which is a real estate holding. They do self-storage. CVS I sold. Devo is a Dividend ETF that also does option selling. It's a large holding of mine. Duke, which is Duke Energy, it's a utility. GILD, Gilead, I sold. GIS is General Mills. HASI, which is Hannon Armstrong, which I sold. IDVO, which is similar to Devo, but on international stocks. INVH was Invitation Homes. They buy single family residences and rent them out. JEPI, which is the JP Morgan Equity Premium Income ETF, which does it holds S&P 500 companies and rates cover calls. And then JEPQ, which is the JP Morgan NASDAQ Equity Premium ETF. Again, it holds NASDAQ companies and rates cover calls. J&J, Johnson & Johnson, JPM for JP Morgan Chase, KO, Coca-Cola, LEG for Leggett & Platt, LMT for Lockheed Martin, MAA, which is Mid-America Apartments, MET, MetLife, MFC, Manulife Financial, NEP, which is NextEra Energy Partners, NUSI, which is a covered call ETF, O for Realty Income, PEP, Pepsi, PFE, Pfizer, RFI, which is a closed-end fund for real estate, Starbucks, SBUX, SCHD, which is the Schwab US Dividend Equity ETF, SPG, which is Simon Property Group, T for AT&T, TD, Toronto Dominion Bank, UTG, which is another closed-end fund that invests in utilities, Vici, which is for Vici Properties. They own a lot of the real estate in Las Vegas and elsewhere around the country. VYM, which is the Vanguard High Dividend ETF, and VYMI, the Vanguard High Dividend ETF for international stocks. VZ for Verizon, WMT, Walmart, and WPC, WP Carry. So that rounds out my current brokerage account holdings. As you see, I have a total of 53 different holdings split up between individual companies, ETFs, and closed-end funds. Okay, so now we're going to move over to the holdings of my IRA. So as you see here, the IRA currently has a yield of 5.23%. A significant amount of holdings as well, which we'll go through quickly. AbbVie, ADC, AGG, which is a bond ETF, AMT, American Tower, Apple, again, is Apple Hospitality, AQNU, which is Algonquin Power, ASML, which is a technology company, Avgo, one of my favorites, is Broadcom, AY, BAM, Brookfield Asset Management. I sold BEP and put that money into BEPC, which is Brookfield Renewable. BIP is Brookfield Infrastructure, BLK BlackRock. BME and BMEZ are both closed-end funds that invest in the healthcare space. BRTR, which is an actively managed bond ETF. BST and BSTZ are technology and science-related closed-end funds. BST invests in large cap technology funds, and BSTZ invests in small or size companies in the science and technology space. CLX for Clorox, CSV, which is a small cap dividend ETF. GIS is General Mills, IIPR, Innovative Industrial Properties, which is a real estate company that invests in the greenhouses that grow, marijuana throughout the country. We have IRM, Iron Mountain, JAPI, JEPI, and JEPQ. Sold out of my land holding, I have MetLife, Manulife Financial, 3M, sold out of MPW. I have some NextEra Energy Partners, and sold out of NTAP, which is NetApp. I have some Realty Income, O, Prudential, PRU, RFI, which again is a closed-end fund that invests in real estate, a large percentage in SCHD, and then you have SPG, which is Simon Property, TD for Toronto Dominion Bank, UL for Unilever, UTG, which is the closed-end fund for utilities, Vici Properties, VNQ, which is a real estate ETF, WP Carry, WPC, as well as a technology-related fund, XLK. And that rounds out my IRA holdings as of today. Okay, moving on to my self-directed 401k. So this is money that I'm getting additional money added to every 2 weeks out of my paycheck. I'm lucky enough to have a company that allows me to pick my own investments in my 401k. So this currently is a longer term portfolio because I can't touch until I'm at least 59 and a half. And so the yield is a little bit lower at 3.96. But as you see, I have AMT, ASG, which is a closed-end fund, Avgo, Broadcom again, Brookfield Asset Management, Bell, BCE, Brookfield Renewable Partners, as well as Brookfield Infrastructure Partners, BLK for BlackRock, CCOI, which is Cogent Communications. It is a telephone related company. DGRO, which is one of my favorite dividend ETFs. I have Devo, which we talked about before, sold out of DLR in this account. I have some IIPR, 3M, NetApp still remains in this account. O, Realty Income, sold out of my Prudential in this one. And I have QQQM, which is a NASDAQ 100 related ETF. And I have QQQX, which is a closed-end fund that invests in the QQQ names and also has covered calls. A very large percentage holding in SCHD. I have STK, which again is another closed-end fund that invests in technology companies. It's actually the #1 best performing closed-end fund over the last 10 years. I have some more TD, Toronto Dominion Bank, and Target, TGT. And that rounds out my self-directed 401k. And last but not least, I have a spousal IRA. So this is an account that my wife allows me to direct the investments in. And so this is from her previous employers. Again, this is long-term money because we can't use it until she's 59 and a half. So we have a slightly lower yield, 3.71. Currently, she holds AbbVie, American Tower, sold out of APD, Avgo, which is Broadcom. We have AY, we have BCE, which is Bell, a BME, which is a healthcare-related closed-end fund, BMY, which is Bristol Myers Squibb, BST, another closed-end fund for technology, CAT for Caterpillar, sold out of Cisco, have DGRO here and DLR. We have General Dynamics, GD, IWM, which is an index fund for your small cap holdings. We had sold out of JP Morgan Chase here in this account. We still have 3M, Merck, Microsoft, NextEra Energy, as well as NextEra Energy Partners, Realty Income O, Pepsi, Prudential, the QQQM, which is the technology related NASDAQ ETF, some Starbucks, a large allocation to SCHD, as well as an allocation to SCHY, which is the Schwab International Dividend ETF, SO for Southern Company, some AT&T, TD Bank again, TLT, which is a long-term government bond ETF, TRO for T. Rowe Price, UTG, which is that utility closed-end fund, VNQ, which is the real estate ETF, VZ for Verizon, and WPC for WP Carry. And that rounds out my spousal IRA. All right, so now that we took a look at all the different portfolio holdings and the percent allocations to each, as we talked about, there were certain buys and sells that I made over the last quarter. So I wanted to talk through the rationale of those buys and sells and kind of explain what I was thinking as I made those sells and purchases. So for the first one is CVS Health Corporation. And this one, I just didn't quite feel confident in their business model going forward. This is a very competitive space. You have Walgreens, you also have Amazon and a bunch of other retailers and pharmacies. And so I just didn't feel like this had the future growth that I was looking for in my investment account. So I decided to sell it to consolidate elsewhere. Similarly with Gilead Sciences, GILD, the pharmaceutical space is very difficult, it's highly competitive, and it really all depends on the future pipeline of the medicines and treatments that they have. And I just didn't feel like I had the knowledge and the comfort level of where this company was headed. So I went ahead and sold and consolidated into another holding. HASI is Hannon Armstrong Sustainable Infrastructure. And so this one was part of my REIT portfolio, one of my 10 holdings in REITs for that particular account. And recently they announced They're converting from their REIT structure to a corporation. And so this changes the business model. They're no longer required to pay out 90% of their income to investors through the distribution or the dividend. And they also don't get the same tax treatments as they did when they were a REIT. And because the main reason for holding it was as my REIT allocation, since they no longer have that status, I went ahead and sold it and bought another REIT with it, which we'll talk about soon. All right, BEP, Brookfield Renewable Partners, is one of my absolute favorite companies. So you might be surprised to see it here on the list. But what I did is BEP, which is the limited partnership version of the shares, has a different tax treatment. You get a K1 with this one. But they also have a BEPC ticker, which is Brookfield Renewable Corporation. And so that gets your traditional 1099 div statement. So instead of having two different holdings of the exact same company, I went ahead and consolidated the two together. So I sold my BEP shares and bought BEPC shares with that. Another one that I sold recently was land, Gladstone Land Corporation. They own farmland, so think nuts and berries and strawberries and grapevines, things like that throughout the country, and they lease it back to farmers. And so I love the business model, but looking at the dividend growth history of this company over the last few years, it just didn't fit my needs anymore. And this was something I held for a very long time. I love the monthly dividend payment, but I decided to use those proceeds and buy VNQ, which is the REIT ETF with those funds. And medical properties trusts. I'm sure a lot of dividend investors have heard of MPW in the news recently. They announced that they're having continued difficulty collecting rents from one of their major tenants. And so the stock crashed like 30% the other day. So I had sold this much before the recent announcement, but it still has not been a good investment and has been going down over time. And while the business itself or the business model itself is very interesting, the execution that the company was doing, the leadership and the management, it just wasn't the right fit anymore. So I sold it a few months ago and used that money to buy other REIT investments. NetApp NTAP is a technology company. There's no real reason I sold this one except for consolidation. I felt like I was having too many holdings. So I went ahead and sold this off and used the money to invest in something already that I have. Digital Realty Trust, same thing. I feel like it's a strong company, but in an effort to consolidate out of individual companies and into more ETFs, decided to sell this and reinvest it. So this one in particular, I put the money into SCHD, which had a higher dividend as well as potential future growth as well. Prudential Financial, again, very solid insurance company. Sold this one just to consolidate my holdings as well. And APD, Air Products and Chemicals. I just didn't feel like I really understood this business. Obviously, they have a very storied history, a great dividend grower, but the current dividend was lower than I needed. And so I sold those shares and put them into something that pays a little bit higher dividend. And so I feel comfortable with that decision. And Cisco Systems, this one was another one that I just didn't feel like I understood their competitive advantage over all the other technology companies in their space. So instead of holding on to something I wasn't 100% sure of, I went ahead and sold it and consolidated that one as well. And then JP Morgan Chase, I felt like I had too much exposure to the bank because I do hold in multiple accounts. And so I sold out of a portion of JPM in one of my accounts and put that money into SCHD. SCHD most of the time holds JPM shares within it, so I still have exposure, but I love the diversity of SCHD, and I feel more confident in holding that ETF than I do the individual bank. Okay, and so some recent buys since September 2023. The first one in one of my focuses for 2024 is JEPQ, Morgan Nasdaq Equity Premium Income ETF. So this ETF holds Nasdaq 100 related companies, and then on the side sells cover calls and options contracts to help increase the yield. So you still hold the individual companies, which the Nasdaq 100 has been doing very well over the last few years, but you also get the current income through those options. So it's a really good balance. They've had really good results, and the payment is around 10% dividend a year right now. Mid-America Apartment Communities, MAA, is, as it says, an apartment community, mostly in the Southwest and Southeast United States. And so when I sold my Hassie shares earlier, as mentioning, I put the money into MAA. So I stayed in the REIT space, just with something with a little bit stronger of a business profile. They generally rank as one of the best apartment communities and one of the best REITs out there. So I felt comfortable with that decision as well. ADC, Agri Realty, is one of my favorite real estate companies. A lot of people compare them to Realty Income, but what they do is they purchase freestanding retail properties and rent them out to different businesses. They're a very strong company. They have great debt record and great history, as well as this very solid dividend growth. So Agri Realty is one of my REITs that I'm focused on building up, and so I just added more to that particular holding. AGG is a new one for me. It's my first bond ETF that I purchased on my account. And so I picked the iShares Core US Aggregate Bond ETF, which is a very broad, very diversified bond ETF. My reason is one, I wanted to step away from stocks a little bit. I mean, this is still a very small position, but with the drawdown in bond prices over the last 2 years, with them raising interest rates, and then with the Federal Reserve talking about potentially lowering rates, I feel like bonds are a good investment at this point. So hopefully we'll see some capital appreciation as well as receiving the payments every quarter. On that same vein, I also recently purchased BRTR, which is a BlackRock Total Return ETF. This is an actively managed ETF that focuses mostly on fixed incomes and bonds. They do also invest in other things around the globe, including preferred shares and things like that. Again, this is actively managed by one of my favorite companies in the world, BlackRock. So I felt like this would give me good exposure to bonds without needing to do actively searching for bonds myself. I'm going to let the fund manager make those decisions for me with BRTR. And as I mentioned in a previous video, which I'm linking at the top, I made a purchase into CSB, which is the Victory Shares US Small Cap High Dividend but Volatility Weighted ETF. So again, it's a mouthful. So what this fund does is invest in small cap US stocks that have a high dividend and low volatility. So again, similar to bonds, I feel like small caps are undervalued right now. And so in order to hopefully take advantage of the future upswing, I went ahead and purchased some CSB. I'll be adding more throughout the year. So we get a good dividend and good dividend growth, as well as the potential for capital appreciation as small caps rise in value over the next few years. And as I mentioned earlier, I am looking to consolidate my holdings into more ETFs. And so one of the things that I've been investing in on multiple accounts is VNQ, the Vanguard Real Estate Index Fund ETF. So this holds a few hundred different real estate investment companies inside of it in an ETF wrapper, provides a good solid dividend and dividend growth over time, and diversifies my exposure to individual companies by investing in the ETF. So those are my buys over the last few months. Really appreciate everyone watching. Hopefully you enjoyed seeing this inside look at my portfolios, the different choices that I've made, the different holdings that I have, as well as the different types of accounts, between my brokerage and my IRAs and 401ks and so on. Just know that dividend growth investing can be for everyone, and it can provide, stable income now as well as stable income when you retire without ever having to sell your shares. So again, thank you for watching. If you want more information, please visit us at dividendstockpile.com or reach out on X at divstockpile. Appreciate it, and we'll talk in the next video.